Welcome back to the Disciplined Troublemakers podcast. I'm your host, Scott Shigori. Here on DT, we talk about scaling technology companies and helping CEOs do this with greater ease and flow. Today, we'll be talking with Chris Kirsch. He's the founder and CEO of the Cyber Marketing Clinic earlier here in 2024. And back in 2021 through earlier in 2024, was the co-founder and CEO of RunZero, a VC-backed cybersecurity company focused on cyber asset attack surface management in that space. Under his leadership, the company grew from under $1 million in ARR to just over $13 million in ARR. Chris's special powers are in product marketing, particularly in the product-led growth or PLG space, specifically around pricing and packaging. In addition to marketing, he's been through one IPO, which I'm sure was pretty exciting, one bankruptcy as well, although I can see he's still smiling right now for those of you who are just listening, so he still has a sense of humor about that. Today we're going to be talking about, or the conversation will be focused around primarily scaling RunZero, but we'll make sure we cover his new or current role as CEO of the Cyber Marketing Clinic as well. I'm sure some of you will be interested in that. Chris, thanks for carving out time to talk with us today, and welcome to the Disciplined Troublemakers podcast.
All right. Thank you very much.
Yeah.
Appreciate it.
Yeah. So let me go ahead and start here, given that RunZero is now, at least in a number of ways for you, a little bit in the past, given that was your last startup experience. In a few words for the context for the audience and stuff, what was the challenge that, RunZero was solving for its customers, either early on and then obviously later on through your tenure for, we'll call it 3 years?
Yeah. So it does sound strange with like all of the IT equipment and security equipment and solutions we have in enterprises today, but companies often don't even understand what's connected to their networks. Right? And even if you think about your home network, if I asked you to make a spreadsheet of all of the devices that are connected to your Wi-Fi and to your wired network, would you be able to do that? And what would you miss? Would you remember, you would probably remember to put your computer on there and your printer and all of these things, but then you maybe forget the smart plug, and maybe you have a Raspberry Pi in the corner that you played with years ago and so on and forgot was there. And so if you think about how difficult that is for a home network, and now you're trying to do that for a bigger network, it becomes really impossible.
Yep.
So RunZero helps companies understand these both managed and unmanaged assets. So managed asset would be like a laptop or something like that. Unmanaged asset would be the thermostat that's connected to Wi-Fi, and do that across IT and OT. So IT, I think I don't have to explain. OT is operational technology. So that's a lot of the equipment that you have in a factory that, opens and closes a gate or something like that, and then also not just the local network and the cloud, of course, which a lot of companies have expanded into, but also mobile and remote assets. So it gives you a comprehensive view and then helps you understand the security implications of that. So patch levels, what kind of vendors you have on there. Sometimes for compliance reasons, you're not allowed to have certain, let's say, Chinese vendors in networks that are connected with government things. But then also, how are these things connected? What's exposed to the internet? Do you have machines that are bridging two different network segments that, an attacker could jump through and bypass segmentation, those kind of things.
Yeah, no, I think it is always still surprising to me what the lack of visibility that even nominally sophisticated IT teams or OT teams, if there's a division there, or just companies in general, really don't, they just literally don't know. Or there isn't an overall just kind of even priority around trying to understand what that is, let alone spinning up instances on AWS or pick the platform of choice to then other connections that you might have, production versus beta or some other testing environment, assuming that even exists. Yeah, it's always still remarkable to me, I think, in 2024, just how little people or teams do genuinely have a total footprint or total understanding of exactly what's on their network, what's going on with it. Given all of the tools out there, you'd think it would be very covered, but it's not. It's not even really close. Yeah. Interesting.
It's so fundamental to building a security program. I mean, how can you start to even think about your attack surface and like what you need to protect if you don't know what your network looks like?
Yeah.
So it's both shocking that it's not a solved problem, but it's also not surprising because it's a really complex problem.
Yeah, it is a dynamic environment. Lots of teams aren't talking to each other, whether it's siloed, it's marketing versus somebody else or something. We were all familiar with, if we spent any time in the networking space. I cut my teeth on networking and client server environments 20 years ago, building them from scratch. And it's very easy to just try different things, but then quite honestly, in the rush of events, either forget about it, that it might still be running, or that it's just something that still is on unless you physically turned it off. And, again, it's just, there are perceived only so many hours in the day. So yeah, that is certainly, certainly fair enough there. In terms of specifically around scale, because you've got so much experience in the sales and marketing domain, particularly PLG, et cetera, how did you approach go-to-market? And how did you get traction with your first customers? And did that in any way shift fundamentally as you continue to scale? Because obviously what you're doing at 13 million in revenue versus $1 million or even 3 is a lot different, or can be. So what was that approach? And then, in terms of traction with, maybe we'll start with your first customers and then later on, if you're comfortable sharing that.
Yeah, sure, absolutely. And you're absolutely right. What works in the beginning doesn't always scale, and what scales doesn't always work for you in the beginning, right?
Yeah.
So my co-founder, who is the technical founder of the company, is H.D. Moore. I'm mentioning him because I think you have a cybersecurity background, and maybe some of your listeners do. So he first created Metasploit, and so he really built quite a good name for himself with that project, and has done a number of research projects and so on. So he's got a pretty big following on social media. So when he had the idea for the product and started building the product, he actually built the prototype and started the first go-to-market about 2 years before I joined. So and that was just him in the company, and he was just trying to figure out, is anybody even interested in this problem? Does my approach work? Is anybody willing to pay anything for this product? The difference between $0 to $1 in price is much, much bigger than the difference between $1 and $10, right? For somebody to even take out their credit card.
Yeah.
So he had built a really good basic business with a pretty mature product already. And he had primarily sold that through his social media. He had, I don't know, I think, this was a time when Twitter was still Twitter, and, a lot of people were on there, especially information security. And he had, I think it was like 90,000, 95,000 followers or something like on there. Yeah. So he had a very, very good base, organic base to market into. Not every founder has that, right?
That's true. Yep.
And then LinkedIn was another 20,000 or so followers. So he had a very, very good social media base to market into in his ICP with the people that he's communicated with in the past that have an interest in what he's doing. So that was the low-hanging fruit. That doesn't really scale. So we had to do different things later. The social media strategy he paired with a PLG strategy. So basically, how can he reach as many people as possible and have them try the product and have that be with the minimal friction possible, so that he, who's, before I joined, he was the only employee coding the thing, and he was doing it part-time because he was still getting healthcare from somewhere else. So he figured out a really low friction way to get it into people's hands, and then also to swipe their credit card, and we just processed it on Stripe, right? So that was the first path. And then when I joined, he already had a lot of small customers, some enterprise customers, and a lot of people who were interested, and he just couldn't keep up. So that was a very good problem to have. That showed
Yes.
me the product already has product market fit, and we now need to put a go-to-market engine behind that to help it scale. So I did the usual things, relaunched the website with fresh messaging, a little bit of spit and polish to make it look nicer. Then we rolled out HubSpot as a CRM and marketing automation platform, which was also a good choice at the time. Later, we moved to Salesforce because it just didn't scale at a later point. But for the beginning, I thought it was a good fit.
Yep.
And one thing that was really important is that I got his buy-in to pipe all of the PLG leads into HubSpot so that we would have visibility in HubSpot of everybody who's signing up and registering.
I see.
Right? And that we also get some telemetry from the product. For example, how many devices have people scanned? How many users are on the platform? When was the last login? And so on. And I built automated drip campaigns that were based on the behavior, the number of days, the role. I basically wrote some logic that figured out the level of the person. Is this an individual contributor or a VP? What role are they in? Are they on the red team, on the blue team? Are they in consulting? Different personas. And then HubSpot also gave me the industry. So I was able to actually really well tailor the nurturing stream to the people who were signing up, and the emails automatically came from the sales rep who the territory was assigned to. In the beginning, that was me, and then it was like 3 people, and then it was more and more people. So when people responded, then the automatic nurture turned off, and the person took over. But until then, we used just the information that we had. And we had certain triggers that would indicate that this is maybe an above average, there's some kind of buying intent or an intent that it's a good ICP fit. So for example, if you have somebody who scans a network that's over 250 assets, that's probably not somebody's home network, right? Or if they are, they're, we had all sorts of people, and I'm sure there are people who have bigger networks at home, right? But if they reach a certain size, that was a criteria to. We didn't call it lead scoring, but to trigger something for the sales rep to say understood. Like, hey, this is an account that's interesting. If somebody invites a second person into the account to have a look at the assets, that's also a buying intent signal. Because now it's not just a lone wolf trying this out at home or in a company. They actually found some value and found something interesting where they want to show it to another person, right? Yep. So that was another thing where we said, okay, that we need to flag, and then we can do additional outbounding to map out the account from a sales perspective and so on, and to reach out maybe over LinkedIn, over phone, the usual ways. Yep.
No, it's always, I think, interesting, particularly because it didn't used to be called PLG, but it was still a very, if you will, popular or meaningful way. Obviously, it's consolidated around the PLG label or name, and it gets talked about a great deal now. It's just always interesting how a team both thinks about PLG, I will say that strategically, and then the actual mechanics, which is great for you, I think, to describe, because oftentimes it's not articulated in terms of, yes, we use HubSpot for this period of time, yes, we did this, and this from a, if you will, tactical, practical, and then just iterate that and think, oh, okay, well, this one at 500, assets, and we've got a second or third person within 3 days or 5 days or whatever, is to really kind of think some of that stuff through, where I think a lot of teams, when I listen to, like we all do a number of podcasts, they struggle in terms of trying to think through, okay, what should what you just described look like for us, given our particular approach and what we'd like to do, which I think is meaningful. So a big thanks
Yeah.
for sharing
And
those details.
Yeah, and it's whatever you can measure, and then whatever is meaningful out of the things that you can measure,
Yeah.
right? And if you can't measure them today, but you could potentially measure them and pump them into the CRM, then think about that too.
Yeah.
So then the next thing was, we communicated through social media to his base, my base. My base is a lot smaller. Mm-hmm. And then the question was, okay, how else can we reach some of the early adopters in security? And also when we thought about the kind of product that we offer, it was not crazy to explain what the product does. We find stuff on your network, that's pretty straightforward. But the claim that we made, that we could find more than your average product, and it was in this case unauthenticated scanning and the kinds of things we could find. Mm-hmm. It's a bold claim, and a lot of people don't believe you. So that's why we had the very easy PLG motion to show them the money. You have to have really fast path to value. But then we still had to convince people on a cognitive level to even try it. And I actually found that podcasts were a good way to do that, because it's not a single headline that explains how we do it. It's a little bit more nuanced and a little bit more long form. Mm-hmm. And with podcasts, you have somebody's usually undivided attention, sometimes divided attention, while they're driving or running or doing something else. But mm-hmm. With their head, they're paying attention. They're paying attention to you for longer than a 7-second clip that you put as a pre-roll ad on a YouTube ad or something like that.
Indeed.
So we found that podcasts worked really well. We got a lot of organic invitations when we were reaching out to people because he had a good name. Sometimes I went on the podcast and so on, depending on who they wanted and availability and all of that stuff. Yeah. And that helped us drive some traffic. And it was a mix of sponsored episodes and earned episodes. But at one point, it didn't scale, right? So at that point, we then started to do the usual. So demand gen campaigns with certain assets, email marketing, all of the usual. One thing that still works well if you have good data is some kind of research report. So if you look at RunZero today, they have a ton of research, a ton of really good stuff, very talented researchers that come up with data that few other people have.
Yeah,
right?
That's interesting. Yeah, I did notice a number of, I use the term white papers, but again, we'll mm-hmm. call them research broadly speaking. Yeah. Obviously, they can be sliced and diced in different ways. Do you find people just automatically look for that, or is it a case where they receive it well, or it is considered to be in the security space in particular, just something where it is perceived of greater value? It's not a marketing piece. It is indeed a research piece. Mm-hmm. And did you need to just give that or share it? Or was it a case where at conferences and things like that as to how you would, if you will, introduce them to your white papers and other materials of that sort for the next level of drive?
Yeah, so there's different strategies you can run, and it depends a little bit. I'm not the biggest fan of launching research or new versions of a product at a big trade show because your share of voice is so small, right? Sometimes it helps to do it before the show. Let's say do it 3 weeks before the show. That way people hear about it and you can use that as a hook to get them to a meeting. Because if you launch it at the show, then there's not a lot of time to actually book a meeting and so on.
Yeah.
And before the show, you have more noise than average, but it's still a little less than at the show. So sometimes that helps. Or you can just completely decouple it from the physical events. Because if you also think about the big events in the industry, those are always a bottleneck for your marketing team. So if you add something on top there, I'm not sure if that helps. But you also need some reason why people should come and talk to you, right? So you got to strike that balance.
Yeah, no, it's true. The
right.
Conferences can be exciting, but it's tough to kind of get that cut through.
Yeah. And then you also have the choice, do you partner with somebody in the media as an exclusive and give them some of the data ahead of time or all of the data ahead of time. They write a big piece on it, right? And put it out, and then other places follow, or you do a little bit of a press tour. You can go to the influencers, to the podcasts, to the YouTubers, send out a press release, those kind of things, and try and get coverage that way a little bit more slowly, a little bit more over time, and talk about the research. I think that's a good way. And another option is you can, I think a lot of the research papers pack too much into one report, and it's just like razzle dazzle, and you get a lot of information. It's a very rich, good report, but not all of it ends up in the coverage, and people can't retain it, and it's just a little bit too much. So if you have a lot of really good research, I would almost chop it up and drip it out over time, right?
Yeah.
So you might not get an exclusive each time, but now you have a really good social media stream where each week you have a cool new fact that you can share.
Yeah, no, it's true, and we're, in every aspect of our lives, but particularly for those in tech, and then exceptionally so in cyber. There's just, I'll call it information overload. It's just, often noise overload. So I agree, having read any number of white papers and stuff, some of them are awesome, but trying to get through them and, like you say, retain that information in a meaningful way and then be able to leverage it in some either conversation or to help somebody out can be really, really quite tough. And there's just, it's just hard when you want to help other people. Yeah, most definitely. Yeah. In terms of continuing with the scale, you obviously would have had to scale the team and your processes a lot. You've talked about some of that, certainly with respect to HubSpot and some other things. Is there anything on the, in terms of on the team side that you want to, share for, CEOs and cyber tech leaders for those who are needing to do the same thing?
Yeah, sure. So I find that, not the same strategy works for everybody. And so one of the biggest differences in how you scale a company is, are you bootstrapped or do you have VC cash? I mean, that sounds a little bit obvious, but I'll go one click deeper. If you are bootstrapped, you probably want to hire, and let's say you're hiring your first person in marketing. You probably can't go for somebody with like a ton of experience, right? Because they'll be too expensive. You can't go with somebody too specialized because they need to be a generalist. You probably want to hire a little bit more for aptitude than for experience, because if they have experience at a certain stage and you grow, then they're going to be out of a job pretty quickly because they're no longer a good fit.
Oh, I see.
Right?
Yeah.
So I would say, but you also can't go with no experience because then you have to babysit them 24 hours a day. So I would say if you're bootstrapped, your first person should be like a third experience and 2/3 aptitude, so that hopefully you can retain them for a longer time. They're more flexible, they're more creative in getting stuff done, even with a small budget.
Yep.
And then hopefully that person grows over time, and either they move into the first seat and start a team under them, or they grow with the organization and you eventually have to hire over them, and they learn from that person, hopefully, if that's what they want to do and if that's okay for their ego, right? Right? Because
it's such a huge part, but
right?
It's absolutely
and
critical.
There's no right and wrong thing. I believe it's better to suspend your ego and learn, because it's the better long-term strategy. But
Indeed.
It really depends on the person.
Yep.
So that's if you're bootstrapped. If you're VC backed and you have the right traction, then it makes more sense to do something that I would call scaffolding, where you hire, the first person you hire in a department is, let's say, a director level, who really understands how that function should look in a year or two, and starts putting the processes and the systems and the people in place, right? So they're learning less on the job. They should be somebody who's been in that role before in a previous company, that maybe they haven't built it before, but they've run it before, and they know what good looks like. And so they have a blueprint and they can put it in place. That scales up faster because they will do the hiring, they will make a lot of the decisions, they will probably build a more professional department than your bootstrapped guy would do. especially because as a CEO, you are very unlikely a specialist in all the different departments, right? Okay. So you can guide people, but you can't really tell them what to do with a lot of expertise in a particular area. Like, I hired a legal counsel. I've read contracts before. I know a little bit about the law, but I'm not a lawyer, right? Yep. So I can talk through with them what I think we need to do, get our house in order for the next due diligence because we want to do fundraising, protect, redo the contractual work and the EULAs and, streamline contract reviews with customers, those kind of things. But apart from that, I can't really judge the department. So if you hire somebody who's got more experience and who can do the hiring, you've got a lot more off your plate. And that allows you to scale faster and with less risk. The biggest challenge, of course, is to figure out how quickly you should grow, right? And I myself got this right for the first 2 years and got it wrong in the third year, right? So in the first 2 years, we anticipated the growth, sometimes a little over, sometimes a little under. And in the third year, because for the first 18 months, we were cash flow neutral, which was great, while growing very fast. But then our investors said, like, hey, you have to, step on the gas and hire more people because there seems to be a huge opportunity here. And we did, and we made the joint decision to do that. But there were a few things that happened. Some were in-house, some were external. SVB collapsed. The market was soft in 2023. In-house, it took me a lot longer to hire a CMO and a CRO to upgrade the team than I thought. And that meant we didn't have the pipeline, et cetera, et cetera. So it was a number of factors. And that way we overshot in terms of investment and scaling and then had to pare back. So we had to do 2 rounds of layoffs, which really wasn't fun, right? Yeah. And so, in theory, this building up is very easy, but you don't have a crystal ball. You're planning for the future and you've got some plan numbers, but you don't know if you're actually going to hit them. So my biggest advice would be to be slightly on the conservative side, because the bet that you're making as a founder is different than the bet you're making as a VC. A VC's got 10, 20, 30 investments in different companies. They can take bigger risk for each individual one because it'll even out. Correct. But as a founder, you have one bet, right? So there's always this tension between the founder and the VC in how much to invest and how fast to spend, right? Yeah. And so it's a little bit like when you've got your stock portfolio. You don't want to have all of your stock and all of your money in one stock because it's very high risk. If you spread it out, it's easier. And so the VCs are a little more relaxed and they're like, we could take more risk. And they also need to take more risk because they need a bigger return, right? Yep. They need one of the companies to work out. You need your company to work out, right? Yeah, and that's the challenge.
Yeah, no, it's the alignment, I think, of incentives amongst various stakeholders between the founding team or the founder, if there's just one founder, and the VC team or multiple VC teams, depending on how that structure looks like. Yeah, it's just, to me, it's always very fascinating, and how, as you correctly point out, who is incentivized by what are those risk factors, what are the opportunities, how quickly and when, and what everyone's perception of those risk, reward, and opportunities happen to be. Has the market shifted? Should we pull back? And how quickly that can change depending on what, frankly, what pressure the VC team happens to be on. Have they had 4 that have blown up? And they're looking for you to put on that special cape and be able to deliver, outsized performance, because they're, also, raising their next round, which is always what they're doing. I mean, used to work on Capitol Hill. Everyone was always, campaigning. It's no different. You want more and more assets under management and to be able to grow. So I think, understanding that, I think generally speaking from the folks that I talk to, many of whom are bootstrappers, ultimately but just understand which game you're playing.
Yeah.
Understand the field of play, understand your playbook, and just deeply understand who the other stakeholders are and what pressure they are under now, and you anticipate that. So are you getting an investment early in the fund's life, or is this something that's coming in year 5, and what does that mean for you and your team and the window or windows that you do or do not have? Yeah, I just don't think that can be, as much as we talk about scale, I don't think that can be really emphasized enough. We always hear about all those that are, supremely successful on Crunchbase or, pick your publication of choice. But I think hugely great advice as to how to really think deeply through what you've just described, because the implications are profound.
Yeah. And I can understand both sides. I absolutely understand the VCs. But you just have to be open and honest about the slight misalignment in priorities.
Yeah.
Right?
Yep.
You both want the company to be successful.
Indeed.
It's just the level of risk that you're willing to take to get there.
Yeah.
Yep. So you asked me about scaling the company. So this was about building the team, especially the starting team.
Yeah.
And then I always also thought about, okay, what are the kind of processes that are going to start breaking if we start executing to plan? So let's say you want to triple revenue. Mm-hmm. In our example, first year, first I did the order fulfillment, and then somebody on the sales team did the order fulfillment, but they were also a director of sales, right?
Okay.
So they had a lot of work just getting the orders processed, because we not only did enterprise deals, we also did a lot of smaller deals. So the volume was quite high.
Okay.
And so that took a lot of time. So we thought, okay, if we want to triple sales, is this still a feasible process? And you can either augment that with people. You can say, all right, we just got to hire a sales ops person, and they're going to do the order fulfillment. Or you need to change the process, or maybe you do both, right? Then another example is, let's say you want to triple revenue. What does that mean? Okay, well, you can't just triple everybody's quota. So you got to hire more salespeople. So what does that mean? So maybe instead of 3 people, you now have 9 people on the sales team. Yeah. So now it gets a little bit harder to just get people in a room, huddle, just say on Slack, hey, can you just join a Zoom call, and let's update you on the latest messaging and campaign and all of that stuff. With 9 people, it's still possible, but you start reaching a point where you have to be a little bit more planful. In the beginning, the salespeople you hire are working with you on the messaging and on the pitching and on the positioning and on the whole go-to-market motion. Mm-hmm. Later on, you have to have that baked, and you need to enable the sales team, and you need to have materials and processes to get them up to speed. Mm. So you got to think about that and make that switch and anticipate those kind of things so that you can better scale.
Yeah, no, right? It's just, I think it's, PLG often sounds, a solution to many, many problems, and I'm in no way suggesting that it is not. I think we underestimate just the complexity to get there, and then the choices that need to be made, or the trade-offs that need to occur, whether it is enterprise versus small to medium size. But we love the small to medium size folks, but the enterprise folks, the leverage there is different. It's just, again, like anything else in life, you've got to, you have to choose as best you can with where you are while you're, as we often say, building the plane while it follows through the sky. So yeah. Along those lines, because I'm really kind of interested in your perspective on pricing and how you guys approach pricing. There are many ways to do it badly. I'm smiling because when I talk with people and I ask them, oftentimes they'll say, well, we just did what everybody else did. Well, I had a gut feeling about X and Y on our product, on our portfolio, so we just kind of spitballed it. Well, we did some things here, and then we just tried to, plus 10%. It's just kind of, it really is. It's kind of all over the place. I'm sure that you were more systemic about it than some of the folks I've talked to. But how did you guys approach and think about pricing in the space where you were, in many ways, a sizable participant? You could be shaping that market and therefore shaping pricing. So how did you guys, with, again, what you can share, how did you approach pricing?
Yeah. So pricing is probably one of the most complex topics in marketing. If you want to put it under marketing, you could put it under other buckets as well.
Yeah.
At a previous employer, we had some challenges with pricing, and it wasn't the pricing level. It was the pricing structure, specifically the pricing metric, how we were charging. So at the time, to try and solve that, I basically dove deep into pricing for 6 months and read everything I could get my hands on. So I probably think about this topic a little more than most people. And there is no one motion or process that works for everybody. It's a little bit nuanced, but broadly speaking, what I do, like let's assume you are a startup and you're trying to figure out your pricing, right? So greenfield opportunity.
Yep.
I think it starts with your ICP. Who do you want to sell to? And it's not only who do you want to sell to, but also where is the product the right fit? Where do you think is enough willingness to pay to sustain your business and to grow your business?
Okay.
Then second thing is, how do you package the product? So do you want to have different tiers, and how do you differentiate the different tiers from each other? Like you go to the standard SaaS pricing page and you have like a good, better, best model.
Yep.
And sometimes the good model is a free tier, or it's a cheap tier, an entry-level tier, and so on. For each of these tiers, you need to think about a certain persona or use case, or maybe a slightly different ICP that you're targeting. If one is mid-market and one is enterprise, if one is consulting and the other one's enterprise, you need to not just say good, better, best. You need to have an idea of who is my customer for each tier.
Yep.
And then you figure out, and if we're talking about good, better, best, assuming that good pays $1 and better pays $2 and best pays $3 for it. So you have the willingness to pay appropriately assigned to these different tiers. Mm-hmm. Then you figure out what are so-called pricing fences. So pricing fences are things that a higher tier would need, but a lower tier doesn't care about. Mm-hmm. So let's say, I'll give you like a nebulous example, advanced reporting. Right? Mm-hmm. Enterprises might need advanced reporting. They might need geo-redundancy. They might need a few other things. Some companies put single sign-on in there. I would not recommend that because it plays really badly with the security folks, because it's essentially a tax on better security for the product that you're selling, and that doesn't play well.
Interesting. Okay.
But so you try to identify these pricing fences, and you have to be honest and open. Like, would this actually, if an enterprise customer came and they wanted to spend less money, could they do without this feature? You see what I mean?
Yep.
So it has to be strong enough so that people would self-select into the pricing tier that you want them in, and where you have the right price point for their willingness to pay. Mm-hmm. That is sometimes intuitive, and sometimes you can figure it out through studies and surveys and those kind of things. But for a startup, probably interviews with your target audience would probably be best.
Yep.
You don't necessarily ask them how much are you willing to pay and so on, but you ask them about hey, you have in mind which bucket they fall into in terms of your segmentation, and then you figure out who cares about what. You can do that in interviews. And if you have enough volume in your customer base and you can get statistically relevant results, you could also do a survey. But usually if you're just starting out, you would just do interviews and do your best. And then So you've got the good, better, best model. That's a feature tiering. And then you got to figure out the volume discounts, or actually the actual dollar amount, and then the volume discounts. So, people who buy 10 users pay more per user than people who buy 100,000 users. I see a lot of companies struggling with that, because typically in startups, the engineers who try to make it, really precise, and it has to be like a very straight line and a smooth curve and all of that stuff. And they don't want that, somebody pays 10 users, but is actually paying less than for the 9 users. That's micro optimization. It doesn't help you.
Yeah.
And what I also often see is that the companies go way too steep on the volume discounts. So they say like, well, I have to increase the discount with each step. And because they want to get the curve super smooth, they have to make smaller and smaller buckets. So 1 to 5 users, 5 to 10, 10 to 15. I'm exaggerating. But the smaller you make the buckets, and you still want to have a meaningful different discount, now you end up and you earn nothing when you do a 100,000 user deal.
Yeah.
So, make the buckets in sizes where it makes sense. It doesn't add too much operational complexity. If somebody figures out that they can get a cheaper deal by buying 100 users than by buying 90 users, good for them. That's fine. But the discount curve, I recommend keeping the discount curve relatively flat. You want to have, in the beginning, you want to have some curve and so on, but don't take away your pricing ability, because at the low end, it's going to be price list with maybe a little bit of a 10% discount. At the high end, whatever the volume discount is, they're still going to negotiate after that. And then you make no money on the big deals. So that's a mistake I've seen a lot.
Yeah.
Now, you were asking specifically about the last company. So when I came in, HD had already launched the product. He had already put a price tag on it and was selling it online. And when I say PLG, by the way, yes, we did have an online checkout, but most people bought with invoice, and it was more like a PLS, like product-led sales motion, right? But what was important was getting the user experience, right? Getting people to experience the product and having that low friction and at scale. So the product, because he was trying to figure out, do people even pay anything for this? His price level, even though he'd gone up over time, was still very, very low.
Yeah.
So one rule of thumb for me is, if nobody's complaining about your pricing, you're too cheap.
Yeah, and I'm with you 100% on that. Yes.
Right? Because there is a very interesting method to figure out the right price or right price range for your product.
Yeah.
It's called price sensitivity measurement, or the guy who invented it is Van Westendorp. So sometimes it's called Van Westendorp price sensitivity measurement. And basically you ask 4 questions. And this mostly it was developed more for consumer goods, but you can, if you understand the concept, it's actually interesting just conceptually to apply it to enterprise sales and to your pricing. So you ask 4 questions and think about like a Beyonce ticket, right? I'm selling you a Beyonce ticket. First question you ask is, at what price would you say, this is so expensive, I won't even consider that, right? Maybe $500. Then, depending on, I don't know how much of a Beyonce fan you are.
Yep, it's true.
Then, at what point do you think, this is so cheap, this can't possibly be a real deal, or the tickets must just be really bad, right? Like, I'm stuck behind a column around the corner, or it's a scam, right?
Yep.
Like, maybe like under $30, $40, this can't possibly be a good ticket, right?
Yeah.
Then, okay, so then third question. At what point would you say, oof, that's expensive, but I'm still considering it? Maybe that's like $200. And then at what point would you say, like, that's a bargain, I don't have to think about this twice, I'm going to buy this right now? Maybe that's $80, right? Yeah. So you ask those 4 questions to dozens of people. And then you plot a line, or actually you plot 4 lines. And so there's like 2 that go like this and 2 that go like that, and you get 4 intersections. And then you take the left and the right intersection. And whatever is the price range between those 2 intersections, that's your optimal price range. And then I think one of them actually optimizes your revenue. So if you have 0 cost for the product, that would also be your ideal, like your maximum profit. So with software, we're almost at 0 cost, but then you've got to factor in the cost of sales, sometimes the SaaS compute cost and so on. So you can get super scientific. In reality, nobody does it that way, unless you're a giant company.
Yeah, I was going to say.
Right, But if you apply this type of thinking and you interview a few customers, you can actually eyeball and figure out like what are the price ranges and what are the steps where people say like, oh, this is where like it changes. Like I wouldn't pay more than $20 a month for this. Like nobody, like it's like sometimes there's these steps where you have a huge drop off. And so I find it useful even in smaller sample sets where you don't have statistical significance. I don't actually draw the line, but I kind of note it down and I eyeball it and so on. I say like, okay, so I get a feeling for how people value this. Yep. The other thing is, quite honestly, if you're in a known category, concert tickets, people know what they're supposed to cost and they have something to compare it to. But if you're in a new category, sometimes people have no idea.
Agreed.
Right? And it really depends on what you compare it to.
Yeah. No, I think, all of that's really sensible advice. What I think is interesting is if you can try and yours does that through, again, an interview process, but you're essentially trying to determine what is the value to that customer segment, et cetera, of the product, service, et cetera, that we are offering. Is it, $20 a month, but they get, 15x out of it on a monthly basis with someone who is, a solid user, or really what does that look like in an interview style, or just some just will obviously do it on a complaint-driven basis, where, like you say, if nobody's complaining, you're obviously not not charging enough. And even after people complain about it, are they actually dropping off? And what's the composition of that drop off? Is it some of your cheaper customers who are costing you a lot, or is it the enterprise player who basically is now complaining in some way, shape, or form? Yeah, it's just, to me, it's always a fascinating subject, and one in which I think can either be, like you say, very complex, or one in which we could just make it simple if you're a team of 5 and you're simply trying to get to a certain revenue number without, compromising the value that you do offer into the marketplace and that you're convinced of, even if it's just, quite honestly, more intuitive in nature than, having, all of that hard data in front of you, which you usually don't have when you're new. Yeah, nope. Well, why don't we go ahead and take just a short break, and we will be right back with Chris. Purple Finch Group helps technology CEOs innovating at the edge of chaos create operational fitness across their technology stack and team of talent. Achieving significant and measurable scale, selling your story, and finding time to think and plan can feel like a bridge too far. So if you're a CEO whose company has found product market fit, but is struggling, or you're a CEO whose company is looking to accelerate existing momentum, we can help with proven blueprints for optimal scale. Shifting from incremental addition to exponential multiplication can be absolutely achieved with less effort and stress. To get in touch, I can be reached at Scott with 2 T's at purplefinchgroup.com. Now, back to the interview. Well, welcome back to the Disciplined Troublemakers podcast with Chris. Let's go ahead and shift gears a little bit. We've been talking a lot about, RunZero and pricing and scale and so forth. What type of work that you're doing now gives you real energy and joy? Because being that CEO, I'm sure, was both exhilarating, but also very, very stressful at times too. You've made a shift. What brings you really kind of happiness and energy into what you do now, please? Yeah.
So I really enjoy partnering with startup founders to get clarity on their go-to-market. So there are a lot of startup founders that really know their buyer. They're very good at tech, but many of them actually say like, hey, but I don't know how sales and marketing work, right? And they're struggling with that. And they can sell a deal to one of their buyers and so on. They're very passionate about their technology. Their technology is solid. They're solving a real problem, but they don't know where to go from there.
Yep.
So what I typically do with them is, and it depends a little bit on where they are in their journey, starting out to make sure, okay, do they have a well-defined ICP? Do they know their positioning? Sometimes they have that nailed. Sometimes they need a little bit of help. And then figuring out good messaging so that the messaging you can reuse on the website, in your pitch deck, when you do an elevator pitch, all of that stuff, but it needs to be crisp and it needs to resonate and needs to be on point for the positioning and for the ICP. And then to figure out, okay, how do they actually go to market? And this can be marketing campaigns. It can be helping them hire and train their first sales people, because that's often where it fails. I see something, I call it founder sales syndrome, where the founders have gotten their first 10 customers and they've hired, sometimes 2-3 salespeople, and nobody seems to get it. Mm-hmm. And they're stuck. And it takes a little bit of a conversation to tease out what's actually happening, and it can be different things. One thing is, let's say they hired a top-notch sales guy who did 200% of his quota at CrowdStrike every year for 3 years. But CrowdStrike already had like 5,000 people, right? Mm-hmm. If you're trying to put that person into the seat of the first salesperson, they often fail because they're used to working with, a very mature product with mature messaging, sales enablement, a back office team that they can pull in and, they can call the artillery.
Yep.
Here they are, the artillery. Right? So my recommendation is always, as your first salesperson, you need to hire somebody who has worked in a startup before, is scrappy, is intelligent, and can figure out the positioning and the messaging with you. Because also your product evolves all the time, the market evolves. It's often very dynamic. You're not in a startup if you're copying what big companies have done before. That's usually not a winning proposition. So that usually doesn't exist. So you have something new that you need to communicate, and your first salesperson or first 3-4 salespeople need to help you with that. But the first one is the most important. Yeah. And then sometimes, so that's sometimes the problem. Sometimes the problem is that the technology is very, very powerful and can be used in 1,000 different ways. And the founder can pivot on the spot and make it the perfect solution for the customer. But no two customers are alike. And so you can't bottle that up and make another salesperson do that. They don't have the depth. It's not repeatable. It's just, so you got to figure out as a founder, do I have repeatability? Am I always selling to the same role, solving the same problem? Like there needs to be some level to the same size company, to the same industry, not all of these have to be the same all the time, but you have to have some kind of pattern and repeatability. And so if that's not the case, then you probably need to work on product market fit first and figure out, okay, what is there more of? And you can either do that by just continuing founder sales and figuring out when you start having clusters of people that do the same thing, or you can start doing market research and can say like, okay, we've got these 5 use cases that smell like they're good use cases. Let's just do research, quantitative research, like how many of these people are there in the world? Yep. Qualitative research, like interviewing their customers, lookalikes, and so on, to figure out like what smells like a good one, and then focus on that one. As otherwise, you're never going to be able to scale. You might be able to add other use cases later, but if you have too many, it's just not going to work. And so, and then sometimes I help with doing the sales enablement, and that can be one of two things. Either I take the messaging and just turn it into a document that helps the sellers have the conversation. And sometimes, and this is especially true if it's a new category, I have to figure out how to do the value sale and teach that to the salesperson. So bear with me for a moment.
Sure.
If you have a new category and the salesperson goes in and starts with like a very easy deal scoring methodology, BANT, budget, authority, need, timeline. If it's a new category, budget doesn't exist because it's a new category. Nobody has a line item for that, right? It's always discretionary spend. So that means if it's always discretionary spend, yes, you might want to convince the technical person, and if it's a technical founder and they know their stuff and they know their buyers, yes, the technical people might be super enthusiastic about this. But if they can't make the business case to the economic buyer who has the power to approve the discretionary spend, the deal ain't going to happen, right?
Agreed.
So it's another situation where some startups get caught in. So you got to figure out, okay, so it's not existing budget. If it's existing budget, or if you can attach to existing budget, you can maybe stay at the practitioner level. That's sometimes difficult because it means that you're trying to eat into somebody else's spend. So but the established players are probably also doing, they're using up the full budget. So how do you pare that back? You probably can't fully replace the other product yet because you just have a niche differentiation of some add-on and can't replace the full product. So it's a little bit tricky. So oftentimes you have to go with discretionary spend or like some kind of slush fund. Slush funds are usually very small, so there's a small ticket item. So you've got to expand that and make a business case to make your deals grow. So if you need to go to the economic buyer, now you need to make an economic argument. You need to make a business argument. And so I sometimes help the founders figure out, okay, how do they make that business argument? What are the questions they ask at the lower level? What are the materials they need to prepare? So that even sometimes the technical person on the customer side goes to the economic buyer by themselves, presents it. You don't always have access to that person. Ideally you do, but you don't always have it. But you need to arm that person to make that sale.
Yeah, no, I think, again, it's a fascinating topic because, the founder or founding team, if there's, one or two of them, there's usually someone obviously leading on the product side that they have the original philosophy. It was probably a personal frustration of theirs, that they wanted to solve or felt compelled to do that on behalf of other people. They have all the wins and losses and the scar tissue to show for it. They have all that expertise. They therefore have an enormous amount of context with which to, if you will, sell that widget, that thing, that whatever you're doing, and to shift that off to someone who doesn't have any of that. It's that CrowdStrike person, as you mentioned earlier, or it's somebody else who's scrappy, but again, isn't going to have that simple or deep depth of experience. It is very tricky to try and find, the right person for that particular period in time and then see how they grow. It's a special set of skills to be that director of sales, or maybe it's the, chief revenue officer, whatever the label's going to be. And then to your second point there, figuring out between user and economic buyer, are they the same or not? And then if it is the economic buyer, you're making that economic argument. Do they, I don't want to say don't care about the tech, but the very languaging and how you share what you do and the story that you tell can be very, very different as to, based on what the incentives are of that particular person and or team. We assume that economic buyer might be one person, but often it's a process instead, particularly at the enterprise level. Having worked for Raytheon and Northrop Grumman, it was absolutely a process, and could end up being candidly kind of, or feel like it'd be a soul crushing one for a young founder. So, just a very dynamic and challenging thing to do with, even again experience elsewhere in sales, or again just having that deep knowledge and being very excited about what you can solve for somebody's cyber challenge. Yeah, most definitely. Yeah. No. So with the work that you do now, is it mostly founders, some of whom will be listening, who are VC backed, or do you also help or wish to help those who are bootstrapped? Do you have the ICP there as to who that ideal founder and or CEO is, so that again, when people happen to come across this, that they're like, okay, I need to reach out to Chris. Our team could use some help.
Yeah. So most of the companies I talk to are between seed and B. So most of them gravitate around Series A, because that's when they start having some budget to pull me in and so on. I've had some seed companies pull me in. It's more on a project basis usually. Sometimes it's just, sometimes I just jump on the phone with them and just have a conversation and help them, and it's pro bono and it's fine,
Yep.
But where I make my money is around Series A. I have one customer that's private equity stage, so I've worked in bigger companies as well, and the work is slightly different, but I can flex up to that as well. But I find Series A is when they're starting to build an internal marketing team, or they don't have one yet, They're trying to figure that out. They've got some product market fit, and they're trying to figure out the repeatability and the scaling up and so on. That's typically a good stage where they bring me in.
Gotcha. Okay. Yeah, I wanted to make sure I asked that, because on a personal level, for me, I do talk with a variety of different teams. Some of them bootstrapped, some of them funded, or going for funding. Others where, again, they're already part of. I do have contacts also either in the private equity space, again, depending on it. I wasn't sure where you might be most interested in playing, so that'll be you will be a helpful resource. So I appreciate that as sharing. I guess as we go ahead and close things out, what would be the best way to reach out to you? Obviously, you and I were from LinkedIn, but I realize you might prefer email. What is the best way for those who are listening today to think, I need to touch base with Chris?
Sure. LinkedIn is usually a good way. So Chris Kirsch, Kirsch on LinkedIn. Okay. Or you can go through my website and fill in the contact form, and that is cybermarketingclinic.com.
Okay. Nope. That sounds great. Well, Chris, it's been a real pleasure having you here on the podcast and sharing as much as you have. It's I know going to be of a lot of value, both has it been to me. It's always great to learn, and then also to share that with people on the platform and on YouTube. So thank you again. And for all of you out there, we will be back, the Disciplined Troublemakers podcast, with another episode very soon. Cheers. Thank you for tuning into the Disciplined Troublemakers podcast, and we hope you found the episode valuable. If you did, please subscribe to the Disciplined Troublemakers podcast on your favorite platform and leave a review. Putting this podcast together is a group effort, so I'd like to provide a shout out to Heartcast Media and their team for all of the assistance they provide with each episode. If you want to get in touch with me directly, I can be reached at Scott with 2 T's at purplefinchgroup.com. Purple Finch Group is the sponsor of this podcast. We have another podcast episode out very shortly. Stay tuned.